Hey everybody, welcome back to Drawbridge Finance. My name's Levi Woods and I'm not a professional investor. I don't work in the finance industry. I'm just a regular guy and I get up in the morning and I do some trades. And last month I was up here in Sycamoose, British Columbia. I sat on this very park bench and I made a video about 6 option trades that were going to expire August 17th. And I told you guys exactly how it was going to work. I showed you the chart up until the point where the stock was at that current day. And I said I'm going to set an upper limit and I'm going to set a lower limit on these stocks. And the stock has an 84% chance of just targeting right through that kind of goalpost that I have set. And for that, I collected some premium. And I sat here and showed you. And I want to say that I'm not some sort of magician. I can't see into the future. I just literally am reading the statistical probability of these things. And I was 100% right. All 6 of them are exactly in the target range. Of course, to be safe, I didn't even hold all 6 of them for the whole length of time. I can't even remember. It was just over 40 days or something to expiration, maybe just around 40 days to expiration. And I knew that I would put on the trades and I would try to hold them and get 50% of the profit in around 50% of the time. And that would bring down my risk level, my risk tolerance on these. So I want to go through today exactly what those trades were. We'll look at the charts and you guys can see exactly what I showed you a month ago, and you can see why what I'm doing works, because this is just completely statistical trading. Anyway, so let's just take a quick look. So the very first one we're going to look at is ABBV, and back in July, on July 6th when I put on this trade, it was trading at $96.92 was the trade. And I sold a call at 105, which is this upper mark here, and I sold a put at 87.50 at this lower mark. And for that, I collected $150. I collected $63 after commission and $87 after commission, totaling $150. And I expected that this stock was going to stay somewhere in this range. Let's just see what it did. Shocking, but it stayed right in that range. It went almost down to it here, and then it came right back up, and we can see this 200-day moving average just continued its line. If I was still holding this, I would be collecting that entire $150. Now, of course, because I like to reduce my risk, I actually closed this position earlier, and I used the $2,700 that I had used to initially put on the purchase for a different trade. And in doing so, I bought these out. So on July 31st, I bought out this call. So here I sold the call, the ABBV, August 17th, 105, and here I bought it on July 31st. So I was -1 or short selling, and I'm +1 on July 31st. It cost me $14 to buy, and I had originally sold it for $63. So this is a simple premise. We know that we can make money if we buy low and we sell high. So I'm selling high and then later buying low, and that's the strategy. It's so simple. So let's just take a look. The put that I originally sold for $87, I bought back for $65. Now the reason I play both sides of this is because if the stock starts to go towards one of them, I make money on the upper position if the stock goes lower, and I lose money on the lower position, but both of them have time decay, and that's what I'm selling. I'm selling time decay. That's it. That's what this principle is. So as long as they stay within the range, I can collect that maximum profit as the time goes by. So of course, if we look at this chart, I sold right around here. I sold when it was $92.39, and it's gone up from there. But had I held it to expiration, I would have collected the whole $150. Instead, I closed it a bit early, reducing my risk and collecting the difference between the $150 that I sold it for originally and the $79 that I bought it back for. And this is on a $2,700 investment. Let's go through these next ones a little bit faster. So Cisco Systems, I actually didn't get a chance to close this trade. Of the 6, this one is still in play. I sold it originally, I collected $104, and now that it's August 14th, I've only got 3 days left on this trade, 3 trading days, Wednesday, Thursday, Friday, and let's just see where it is. Here's the chart. It's bang on. Here's my upper limit of $46. Here's my lower put of $39. And both of these, because the stock is above the short sold put and below the short sold call, both of them are going to expire worthless. So I am going to let these expire on Friday. I will get my $2,600 of margin back into my account, which I can use for another purchase. And I've collected the entire $104 that I originally collected on July 6th when I sold these. Let's take a look at this next one, Intel. So here it was $51, and we expected it was going to, we sold the call at 55 and sold the put at 46. So we had 55, 46. We had an 84% chance of it staying right in this range. You can see the 200-day moving average is going up here. We expected just to cruise right on through, center up in these goalposts, and let's see what it did. No shock here. They just cruised like this is like a target. It went almost dead center. It was almost dead center in here. Today, if I was still holding it, it would be trading around $49 or so. It would still be in play. Instead, I actually closed this position back on August 2nd when it was here, right around the same price, $49.22. And I collected, or I spent at that time, $74. So originally when I put on the trade, I sold the call, sold the put for $192. And I have two choices. I can either let them expire, and I could have held them to the full duration, or I can close them early and take my profits. So I like to close early. Statistically, I have a better chance of doing that. So that's what I did. I closed, cost me $74, and I kept the rest on a $3,000 investment. Let's take a look at the next one, QQQ. So this one, was being quite volatile. The 200-day moving average was kind of creeping up. Everything was bullish on this, and I put on a really tight strangle, probably too tight, and you'll see exactly what happened. So this stock blew out up, you know, before the end of July, it was up over this $180 mark, and that was my upper mark. I had sold the 180 and sold the 169. So I had two positions on in that. $13,000 position, and it's got to stay between these two goalposts. When the stock blew up past this, you know, statistically I knew that I had a good chance of it dropping back down. But to be safe, what I did was I moved this lower goalpost from the 169 and I brought it up to the 180, creating a straddle. What I'm doing there is I'm collecting some more premium, and I'm hoping that it's going to stay right around 180. And because of that extra premium, it gives me kind of a narrow range around it where I'm profitable. But statistically, this is the right thing to do, and this is how I always do my trades. On July 24th, when the stock was up here, it was trading at 180.190, so $1.90 past my upper limit. I bought out the put, which is here, the 169, and I sold it for $180. I didn't adjust the date, I just moved it up in price. So I now have the call and the put both short sold at $180. That's called a straddle, a short straddle. And luckily, the stock dropped back down. It didn't continue to run up, and it dropped back down, and I ended up buying it out on August 2nd when it had dropped back down into this range when the stock was trading at 177.73. So it was right around here that I sold it. So what ended up happening was I originally collected $772 on July 6th. Then, because I moved that put position up, I collected an additional $272. Gives me more money in my pocket, so therefore I am taking less risk. When I bought out the position, I bought it out for $876. So I keep the difference of these. Had I waited a little bit longer, had I timed this a little bit better, it returned right up to around 180. If I had waited 2 or 3 days more, I could have closed this for even a bigger profit. But I was quite happy to take that profit after this position had run out on me. And of course, it's now down today. It's actually down below the 180 mark. So had I left it on completely, I would have been fine. Visa. So we talked about this one, and this again, just straight shot through the goalposts. Here it is. So I sold the call at 145. That's this upper limit way up here, and I sold the put at 125. I collected $296, and just like we expected here, the stock ran up completely, and I ended up buying out July 30th. So right around here when it kind of dropped down to this mid price, so at 137.91, I bought it out. So my original trade, I collected 296, I bought it out for 112. So I collected more than half of my maximum profit, and I cut like 17 days off of any risk. So because I'm closing the position, holding it for shorter amount of time compresses the risk. And then X, same thing with this one. We expect it to just kind of cruise through these goalposts. We've got the call set at $40 and the put at 30, so 40 and 30, and let's see what happened. Ticking along here, and what exactly happened? Okay, so we had this big drop, and I got out of this position. So even though it dropped $32.41, I bought the 40 call and I bought the 30 put to close those positions when it was still within range, because this could have kept going. It could have slid down or it could have bounced back up, but the premium was right. I had originally collected $270 and it only cost me 98 bucks to get out of it. So I kept $172 of the $270 maximum trade. Let's look at a summary sheet of everything so you can just see exactly what happened. This is like my expected maximum percentage return that I could have made was 5.56%. This is what I actually made was 2.63%, but in a much shorter time frame. So I was actually making a simple annual return of 38% on the ABBV. On Cisco, I haven't closed it yet, but I'm likely to make a 34% return. Intel, a 53% return. The Q's only a 17% return, and this was that trade that went bad. The trade went up past my strike and I had to manage it. Visa, you know, managed it maybe a little bit early. I maybe should have held to expiration, but still got out with a very decent profit of 11.7% annually. And X, 155% return. If I did this trade repeatedly every 25 days for the whole year, I would make 155% on that money, that $1,500 investment. So all told, just under $30,000 invested in options, $967 return, or 3.24% in around 25-26 days, except for this Cisco one that's on. So I'm calculating my return on investment at 47.4% if I repeated this for the whole year. And that's exactly what I'm doing. I'm repeating every single month and just making these trades over and over and over again. If you guys are interested in following my trades, please check out my Patreon. It's 30 bucks a month. You can see every single trade that I make on the day that I make them, and you could follow along if you wish. That's it for today. Thank you so much for watching. Let's get rich together.